Hello investors, welcome to today's global macro update for Q2. Just kind of wanted to fill you in on exactly where we're sitting in terms of our framework that we're looking for the year. If you guys remember, we were looking for a kind of shift away from that inflation narrative back towards a deflationary, potentially even a recessionary narrative, which would obviously kind of lend itself towards a very big change in market structures across all markets really. So let's get into some of the charts that I think are important to us for the next quarter and things we're watching for moving forward. So if you guys have been with me for a while, you'll be familiar with this chart. This is the gold silver ratio. And just a reminder what we had here, kind of the 2008 to 2011 Q1 all the way down to the European debt crisis. Very inflationary conditions. Silver tends to outperform gold during the monetary inflationary periods where they're printing money. So we have in Q1 lots of liquidity coming into the system, and we have that big drawdown all the way into 2011 until the European debt crisis comes along, and we start to see a tightening of monetary conditions and a change in that narrative all the way to basically the start of COVID, where we had that same thing. We had a huge amount of liquidity flowing into the system as the Fed started to expand its balance sheet. Central banks around the world started to expand their balance sheets. We had that big drop all the way into kind of 1st of Feb, maybe even March 2021, a full year of that loose monetary conditions. Kind of monetary inflation is what I would like to call it. And then since kind of that February-March period, we've started to see a turn back to the upside. And now moving into, say, the weekly chart, that's a monthly chart. The weekly chart is giving us a kind of corrective structure, which resembles a continuation of a break to the upside moving forward. Very indicative of what we had during the European debt crisis and post the European debt crisis. And now I believe the China debt crisis, which started to occur around that period, is really going to start to accelerate. We have massive lockdowns in China once again. Shanghai's on complete lockdown. We have food riots. We have a lot of issues happening in China on top of their real estate boom, real estate bust, which is busy occurring. We're seeing house prices down up to 43% in some regions, and that's some of the major reasons like Shanghai. So we're seeing some big changes across that region, and I think we're moving into an acceleration of that Chinese debt crisis and a move back towards deflationary monetary conditions. Then we move towards the copper gold ratio, another deflation indicator, but more in terms of economic inflation in this sense. Because we have economic growth, you're going to see people spending a lot more money on copper than they are on gold. They're going to be more aggressive in building, more aggressive in manufacturing, and that's why copper outperforms gold during these periods, during these inflationary periods like we had kind of following the dot-com bubble bust. When that started to turn to the upside, we actually had some good strong economic growth until kind of 2006, 2007, where the house market started to roll over. Copper started to fall in relation to gold, and that accelerated pretty strongly into 2009. Then we had this period again of inflation where it was basically monetary inflation, and people started to believe that was kind of based along commodities, along basically what we're seeing now. Everyone thought, well, prices are going to continue to rise. We need to pile in, start to stockpile these things because prices are going to continue to rise in this environment. And that happened all the way into, again, 2011, that European debt crisis. Then we had that rollover. Basically, the economy rolled over. We went into that 10-year bear market in commodities. Then again, we had the same thing. We had this COVID scare, COVID lockdowns all in March. We started to see money printing, loose monetary conditions, inflation start to run hot, but it's not economic growth inflation, it's monetary inflation, it's speculation inflation, it's supply shortage inflation rather than demand driven inflation. And that's why you would see this kind of push higher initially, but then we would start to see that roll over once again as the realities of the economy come into play. That's exactly what we're seeing now in the US. The realities of the situation are starting to come into play, and we're starting to see these prices roll over. So copper gold chart, we do have that lined up for potential move all the way up to 0.35, 0.30, somewhere in that region. But it's definitely done enough to start to roll over already from this place now, from this 0.618, what we'd call a contracting flat. So we're just watching for this to roll over. And what we're seeing now, we've had the war. The war was long before we saw a peak in the copper gold ratio. And yet we still maintain this region here. So I'm more inclined to believe we've topped out already, and we can start to see that next move to the downside as the economy rolls over and we head into that recessionary conditions. Heading on to the commodity index, the CRB index, and to the guys that have followed me for some time now, we know this is a very important chart for us because it's that same thing, that same narrative. You have QE1, you have that inflationary narrative pushing into the economy, but it's not based on demand growth. It's based on monetary inflation. It's based on loose monetary conditions. It pushes us all the way into the European debt crisis until we go into a deflationary environment once again, where we see commodities push down into COVID. Then we have again a QE infinity, the reflationary trade that pops up higher, and we're in that place now. And now we're starting to wonder, where are we going to start to see this roll over? I believe we already started to see oil roll over, and if you look at this chart in relation to oil, you can see it's basically driven by oil itself. It's such a close comparison that the CRB index, I would say, is probably 70% oil correlation to price. And we'll look at that oil chart in a moment. But what we're looking for now is that same China deflationary trade rolling in now. And I believe oil being at what it is, when oil goes above $100, we see major economic impacts of that. You see fuel price rises, you see food price increases, and you just see all of these initially inflationary price rises lead to deflationary economic shocks. And I think that's the phase we're heading into now. We're heading into that deflationary economic shock, which we've been expecting for some time. If you guys have been following me, you've been watching for this basically since May, March, somewhere around there in 2020. You can go back and look at our friendly warning to friends and investors, which I think was released in May. And we said, watch for this to pop higher initially. Everyone's going to be shouting about inflation. And then this is eventually going to roll over. And we're going to head back to that deflationary, recessionary environment. So we're waiting for that. Unfortunately, this could start to roll over where it is now, or it can continue to rally all the way up to a 0.168 or 0.618 expanding flat, what we call an expanding flat, before rolling over there. So that's the concern that we have now, is how long are these conditions going to last? But there's a couple of things which point me towards not as long as the market believes. So far, if you zoom into the daily, you can see we're starting to get some MACD divergence. We're starting to see some momentum drop off, but we really need to start to see this roll over meaningfully for this narrative to really start to play out. So we'll be watching this chart with a very close eye over the next quarter or so. Moving over to gold. Gold's along that same line. Depending how you're looking at the chart, either we're looking at it as this major, big ABC corrective structure. As you guys know, if you've been following me for some time, that means we're looking for a push down into basically this 1200 to 1250 region, very similar to the kind of level of price drop that we saw from 2008 to kind of the peak of 2008, that 30% drawdown. And if we look at it from here, if we look for a 30% drawdown, then we get taken into that 1400 region, which is perfectly in line with the corrective structure, which I believe we are in now, which could relate to that push down into the 1400 region. If you're not so believing of that, moving to the downside, I must admit it is not the perfect structure. There's a couple of things that I don't like about it. Either way, we'd have to look at this as a corrective structure, and if that is the case, we should see a drawdown towards the 1600 region, probably about the lows, 1660, somewhere around there, before we see the turnaround. Obviously, we'll have to keep an eye on things, see what's happening in the economic conditions before we can confirm that. But if we do start to see that deflationary trade, I do believe we're going to see kind of at least 1400 on the gold chart moving forward. Where we are now, I'm still looking at this as a kind of zigzag corrective structure, taking us up to that 1-to-1 region at 2062, and then we could start to roll over. It's kind of a double top, loss of momentum, big move to the downside to follow. So we'll be keeping a close eye on that, especially if, again, those inflationary conditions continue to roll over and we head back towards a deflationary environment where the Fed is hiking into a weakening economy. Kind of feel for them because they have to kind of hike. They should have hiked a long time ago, but inflation's running hot. The economy's on the move down. We have war. We have a lot of issues, supply chain issues. But yeah, still think that tightening conditions are going to push gold lower moving forward. And the same with, as I said, oil. Again, if you look at the relation to that CRB index, again, we've seen that big push to the upside. But we look at this from a structure point of view. We have a beautiful ABC corrective structure, very similar to those inflationary conditions all the way up to, again, that 2011, 2012. Oil was quite robust at those highs, holding out until kind of 2012, even as long as kind of 2014 in that region, before we saw a very big dump to the downside, eventually bottoming out 16 on crude and even negative on WTI. But when we look at it as a structure, we can see we've got this A wave to the upside, long drawn out B wave to the downside, which is exactly what we like to see. And now you're seeing crude oil push into that 1-to-1 to 1.414 region and potentially starting to roll over. I'll zoom in a second. We can see how potentially we've seen a high in oil for the year and for some time moving forward. Because if we go to something like the daily chart, no one's really speaking about this. We are down already kind of 26% from the highs at 137.94. So watch for this to continue moving lower. We've got a pretty decent, not huge on these, but you've got a decent fib 618 fib retracement, and you've rolled over from there. And if we start to make new lows here, I'm more inclined to believe that this is part of the next leg lower in oil, kind of very similar to the 0809 move there, and that would leave us kind of pushing oil back down sub 50, sub 60, somewhere into that region. Obviously very deflationary if that is the case. And this is a kind of economic damage we're seeing when you see oil prices at these levels. When you see oil at above 100, you start to see what we saw here was the 0809 global financial crisis. What we saw here was the European debt crisis. We saw Arab Spring. We saw a whole lot of issues with oil at those levels. Now we're seeing it at the same issue, at the same level, and we should start to see oil roll over because of the economic damage that oil at those levels does. So we'll be keeping an eye on oil to continue to the downside, and that's why we kind of cut our energy positions in the portfolio, which you guys would have seen on your dashboards, or members, you would have seen that on your dashboards. Then we move over to high yield corporate debt in the US, and again we're seeing a big move to the downside. If we zoom in, we've already seen this big drop from kind of September 2021. Look at the close for the week, 9% down from those highs, a very bearish close this week, just following that downtrend moving forward. And let's see, one of those periods when you see the bond ETF dropping, you're seeing bond yields rising because risk is rising. You see that in 0809. You see that in the 2013 to 2016 period. You see that in the COVID period where we saw that massive decline. You saw that pre-COVID when you saw rate hikes coming into the market, taper tantrum. So now I believe we're seeing the next leg to the downside. All of this is part of a bigger corrective structure. So watch yields to drop below the March 20 lows, or sorry, rise above the March 20 lows, or bond ETF will drop below the March 20 lows, and just shows you the kind of damage that's being done in the corporate sector bond market. Especially the bond market, as you know, is a big truth teller to what's occurring in the economy, and I believe we're seeing this roll over and should see this continue to roll over back towards those March 20 lows. Everything's kind of lining up from a chart point of view. The dollar continues to rally. We closed at or near 100 on the DXY. As you guys know, we've been bullish the dollar since kind of May 21. Even before that, actually, we got bullish the dollar early January 2021. We saw that double bottom in May, so it was a low, slow start to that move. But since then, we've seen a pretty strong rally. Pretty much a strong, consistent uptrend, now breaking 100 on the upside. As you know, this should continue above 100. 107, definitely a close, very reliable target, maybe even burst up beyond that as the dollar becomes the safe haven trade, the safe haven asset that everybody's climbing into, as liquidity dries up and the euro dollar market starts to have liquidity issues. We start to see the dollar rise. We saw the same thing when the Fed started to raise rates in 2018. We saw the same thing, the initial spike for March 2020. And before that, all these dollar spikes, the 08, 09, big spike to the upside, which eventually moved all the way into 2017, a little bit of choppiness, but that was basically a dollar bull market from 08 all the way to 2017. We've gone into a correction since then, and we'll have another leg higher moving forward. And this is what currencies are saying as well. And this is what I want to get into. The currencies we're going to be focusing on today, the Aussie dollar, because of its commodity strength and what we believe the commodity markets to be strengthening, that's going to be very positive for the Aussie dollar. But I believe that's going to start to roll over now as that commodity inflation moves away from supply constraint into an area where there's just no demand at these prices. We're looking at the US dollar renminbi. We're seeing this descending wedge coming out of a big running flat structure, which means the Chinese may start to weaken their currency to try and boost up their exports. And weakening Chinese currency is very indicative of weak global economy. When we move into, as I said, the Aussie dollar, US dollar on a higher time frame structure, as you guys know, the impulse corrective structure, impulse narrative that we follow most of the time, we have a big impulse off the highs from, again, June 2011, the debt crisis period, all the way down to 15. We go into this choppy corrective structure. Heading into the March 20, we see this big rally, a big liquidity rally as commodity and inflation starts to set in. But since then, we've peaked in 8th to February, kind of March 2021, we peaked exactly when we said on the gold-silver ratio, we saw that peak. And now we started to roll over. This week's close, on when you look at the candle, is a big close. We've seen this big pin high following a what we call a running flat structure, or this is more of an expanding flat, actually going right into this blue area of liquidity. And I believe what we're going to see next week is a big move to the downside in the Aussie dollar, US dollar, and that's going to be a big confirmation to us that that big commodity drive has come to an end, and the US dollar is now receiving its full safe haven status even outside of commodities. New Zealand dollar, very similar picture, much cleaner chart as well. When you zoom out, big impulse off the highs from that earlier 2011. They maintained their strength for a while, but then started to drop 2014, went into this bigger running flat structure, peaked again in that Feb 2021 period, and then went into again a big running flat structure. As you know, we like those running flats, nice big A wave to the upside. We actually shift this one over because of the structure and how it evolved, but as you can see, big pin high daily there, and then a big drop down on the weekly chart. If you look at the weekly close, that's a big bearish engulfing, basically knocking out the last 2 weeks of price action in one go. Very bearish sign, and big move down to come potentially in New Zealand dollar, US dollar. US dollar CAD all the way out. Just look at these structures here. You have the 2017, 2018 period where we start to move back into US dollar strength as global conditions tighten. Then we roll over on March 2020 as oil starts to spike. The Canadian dollar strengthens. We said inflationary period, but that kind of leveled out at around about 24th of May 2021. And since then, we've basically seen a rally and then gone into this kind of corrective period. Big impulse off the lows, and then this long drawn out correction basically since August 2021 all the way up to where we are now, April 2022. The next leg for me on this one, on all time frames, points towards a move back up to that 16th March 2020 high, that 16th January 2016 high, back at those levels at 145.50, 147, somewhere around there, probably 147 and beyond. The full target of this move up at 173, which is a big move. The Canadian housing market is in big trouble. I think Canadian debt is going to be a massive issue. I think we're seeing a debt crisis in Canada evolving as we speak as a result of private debt to GDP at levels, just insane levels, and then just really pushed higher substantially with the stimulus checks and everything else. So yeah, we're seeing major issues there. We have the Euro Aussie dollar coming out of a massive ABC corrective structure. As you can see, nice big ABC running flat, kind of expanding flat. Once this starts to turn to the upside, you're looking for a move back up to the 2008 highs. Euro outperforming the Aussie. I think the Aussie market is also in serious trouble. Aussie housing also starting to roll over. We're seeing mass auctions, record-breaking number of auctions going on in the Australian housing market. So that's another indication that we're just seeing rising rates causing massive damage across the globe in all markets. Moving forward, Euro New Zealand, just to show you the same type of structure, an even clearer structure. Nice impulse off the lows, nice big running flat corrective structure, which should see a turnaround to the upside, just showing euro strength versus commodity currencies. So it's not about the euro strength per se, because I think the euro is going to continue to fall against the dollar. But when you look at these commodity currencies that have been performing really well since March 2020, we're at a period or at a level where we could really start to see these roll over. And when we look at our numbers that we like to look at, we're looking right at that 1-to-1 region where we could start to see this turn to the upside, and definitely have a high probability, given the structure, of seeing this turn back to the upside and commodity currencies starting to roll over. A big one for me now is the US dollar Japanese yen, and this is why we're looking at the yen as another pair that has major implications. A couple of things, possibility. It's either going to be, to me, this is a big impulse off the lows, and it's an ABC corrective structure where you have this A wave down, nice choppy B wave up, get into this region here, especially if we break these highs at 125.80, and then we'll see this big risk off rally that sees the yen take its kind of place as a safe haven currency once again, and push kind of back towards the 99, 100 region, depending where we top out. This is scenario number one, but from there, then you'll see obviously the yen start to weaken substantially as that corrective structure completes itself. The other thing we'll be looking for is if we manage to turn around here without breaking these highs, and we look at the US dollar yen chart from a longer term perspective. This is the IDC chart going all the way out to the monthlies. You can see how this chart goes all the way back to basically the 70s. But we have this big impulse off the highs. We've gone into a big corrective structure. And if this plays out, we're seeing the yen take its role as a massive risk currency, where a lot of money flowing into the yen to avert any risk becomes a massive safe haven flow. And we see again the currency moving back towards these debt crisis lows. You see the debt crisis low of 2011. We saw kind of during COVID it held up really well, but if we do see this roll over before this high, at the actual high itself is 125.85.6. If we fail to break that high there and we roll over from these levels now, we will see the yen will have a high probability of seeing the yen drop below 70 moving forward, which is a big move. And that just means there's trillions of Japanese investor wealth flowing out of global markets back into Japan. That's why the yen would be such a strong mover, regardless of the situation we have with the Japanese central bank doing what it's doing, etc. But even from then, even without that move, when we look at the structure itself, even if we do break these highs, the structure itself lends back towards a strong period of yen growth or yen currency strength, which will obviously be related to safe haven flows, and which is obviously not good for the global economy and global markets as a whole. So we're just seeing this defensive position really line up across all the charts, and just indicates to me that we could potentially be seeing a big move in markets to the downside, to a negative period, global recession, I would say, with US markets maybe seeing the brunt of that. And if we go to the weekly, we look at the structures we're seeing on the NASDAQ. Let's actually go down to the daily. It's a bit clearer. Looking at the NASDAQ, looking at the structure again, as you know, structure is really important to us. We have that move off the highs, which we saw again, kind of end of 2021, saw a big push down into 2022. Then we go into a very clean and clear ABC flat pattern. This time it's kind of an expanding flat / regular flat, And since then, since kind of March and this week itself, we've started to see a big push to the downside. When we look at the weekly candle that we had this week, again, it's a candle that's basically wiped out the last 2 weeks of growth in one go and is closed right at those lows, showing very, very bearish potential price action moving forward. So I believe we right now, as it stands, heading into Q2, we're at an inflection point where we're going to see the yen start to rally, we're going to see commodities start to fall, we're going to see US markets continue to fall, and that's going to be a massive problem for investors around the world. As liquidity dries up, we're going to have to get very defensive in our portfolio. So we'll be doing our members portfolio review moving forward. We'll go to it in the next video, but for those of you that would like to join and see where we should be parking our money moving forward, what equities we should have our money in moving forward, you can head to our website and find all of those details in our investor guidance section. It's cool, guys. We'll chat to you soon. Members, I'll see you in the members area in a bit.